Hello once again, and welcome to Tuesdays with Lloyd's, a continuing conversation with Lloyd's underwriters and their distribution partners in London and the US. For today's installment, our focus will be the marine segment, and we have an outstanding panel to share their expertise with us today. Joining us are Louise Foley, Head of Marine and Energy Liability at Markel, Phillip Furlong, Head of Energy, Marine and Aviation with IQUW Syndicate, and Ian Greenway, President of St. Petersburg, Florida-based LIG Marine Managers. Welcome to you, panel. Before we kick off, just a bit of housekeeping. We encourage you to submit questions during the session, but please do use the Q&A tool instead of the chat box. All of our sessions are streamed live on Lloyd's YouTube channel and are recorded to allow convenient 24/7 on-demand viewing. Be sure to check out our YouTube channel, and Mark will drop a link into the chat box momentarily. And with that, Louise, Phillip, Ian, thank you once again for joining us today. And Ian, over to you.
Thank you, Pat. I appreciate the introduction, and I want to add my thanks to our two panelists as well, Louise and Phil. I think everybody knows that just about 2 years ago, everybody's life changed in the world. We were sitting in our offices, sitting at our homes, and suddenly we're sent back out of the office for what we thought was a couple of weeks at that stage. Now, 2 years or so later, we'll talk a little bit about how did you see life change from working on a box or in a syndicate to remote work at that point. Phil, why don't you give us a sharp start of that?
Yeah, sure. Thanks, Ian. I think it was certainly a daunting prospect in March of 2020 when we were all sent home. And I think there was a lot of nervousness around whether the tech would work, whether we'd be able to recreate the business model that we had, with Lloyd's and the box and brokers queuing up, whether we'd be able to recreate that from our spare rooms and our bedrooms and our home offices and all of that sort of stuff. But there was certainly a kind of, certainly in my mind anyway, a bit of a blitz spirit, in that we were all in this huge crisis and we were in it together. And there was a determination to kind of to make it work and to get it right. And it certainly wasn't easy. I'm sure, for everybody on the call, everybody listening, it was a similar experience. When we had that face-to-face contact taken away and our usual way of operating taken away, we had to be creative and we had to think fast in terms of making sure that we got the business placed and making sure that we didn't miss deadlines and not provide service to brokers and clients. But it was tough. And I think people certainly had to step up. Work hours definitely got longer, and there was certainly less of a barrier between being at work and being at home. It seemed like for a while we were kind of on duty all day and all night and, at all times. But that's kind of how it felt for me. I don't know if Louise, if you've got any sort of contrasting views on that.
Yeah, I think one thing that surprised me, actually, because I remember it was St. Patrick's Day when we got sent home. But one thing that surprised me was actually we were quite well equipped to deal with it from a systems point of view. From we were straight on our video. It was technology that we had, but we weren't actually using in our day-to-day lives until then. So I think from that perspective, definitely at Markel, it was quite a seamless transition. And I think as well, as Phil said, our focus was very much on servicing our brokers and keeping up that level of service to the brokers. We've all got each other's mobile numbers, and it just transitioned onto the phone. I think some of the difficulties that we found was making sure that educationally for younger underwriters and things like that they were still included in that conversation with the broker. So rather than just doing it on the phone, maybe setting up a WebEx or Zoom or whichever media you were using, and making sure that kind of osmosis, that people were still learning and kind of experiencing how we would underwrite the risk within the individual teams. I think another huge focus was on well-being, because obviously traditionally in Lloyd's, you have that face-to-face interaction. It's also about the social side of it as well. And I think when you're in a high-pressured environment, actually, that's incredibly important. So there was a lot of focus on well-being at Markel. We had, surveys, but also, just checking in with the team every day, that type of thing. So I think they were the other things that happened overnight effectively.
Yeah, I think the challenge from our perspective was the not really having a pattern to work from. We were doing things in different ways, and sometimes they worked well, sometimes they didn't work quite as well. But as you said, Louise, it's the technology was there, but we didn't always know. Now we're very familiar with how Zoom and Teams and all these things work. But at the beginning, it was like, okay, which button do I push? I think. Phil, you were going to say something there? Sorry.
Yeah, obviously you've got my perspective and Louise's perspective, but I guess they're going to be broadly similar in that we do similar roles.
Yeah.
What we did hear in terms of feedback from some of our broking colleagues, and bear in mind the market environment that was prevalent at the time, rates were on the rise, people were sort of toughening up, performance hadn't been good. And some brokers certainly fed back that they felt a bit more impotent and ineffective because they weren't able to access underwriters face to face. Almost underwriters, it was easier to hide from brokers, right?
Yeah.
Because you weren't going to be in Lloyd's, you weren't as accessible. And I think some brokers yearned for the days when they could go back to Lloyd's and have that conversation face to face, because they felt they might be able to squeeze out a slightly better deal than they were getting when we were working remotely.
Yeah, definitely.
So we've gone largely from face-to-face to Zoom, phone, email type of broking now. And do you see the face-to-face starting to return? Do you think it's going to return long-term? Where do you think the market's going to be? How do you think the market's going to transact business?
Louise, do you want to jump in on that?
Yeah, I think, I think we still hold a great deal of importance on that face-to-face transaction, and particularly when you're leading business or you need a renewal quote or something like that, or there's a significant negotiation that needs to go on. I think there's still 100% a place for that. And actually being in Lloyd's this morning, when I walked into the room, there was that buzz and that atmosphere back, which we don't always get at the moment, but it's definitely building back up. And I think that is of high importance. It provides us with our competitive advantage. A broker can be in the room and get a risk placed, within a day and see, however many underwriters he needs to see or she needs to see. So I think that, that is very important and will remain so. I think the efficiencies that it's kind of eked out throughout this process is perhaps an endorsement. You don't necessarily need to walk into Lloyd's with a name change of an endorsement, and those things are now electronic and dealt with as an aside to the face-to-face negotiation. And I think that's what we're sort of holding on to, but also trying to drive the efficiencies from what we've been learning over the last couple of years.
Yeah, I agree with all of that. I think there were certainly certain areas of the business that Lloyd's that we didn't transact efficiently in Lloyd's. But Lloyd's is also a very efficient place to do certain types of business, especially when you need to have in-depth conversations about complex risk. And really, that's what Lloyd's has always been, right? The sort of epicenter for large, complex risk. I think if you look at Lloyd's offering on the global insurance market scale, we have kind of 2 or 3 key USPs, really. One is the syndication of risk, one is capital efficiency for investors, and then and I think probably the one that's most that people can kind of identify with the most is face-to-face trading and the ability to negotiate face-to-face. And between being asked to do this call by Ian and today, I've joined a working group in Lloyd's which is looking at the future of the underwriting room and what that will look like in the long term. And one of the 2 or 3 key things that they're absolutely adamant that cannot change is that Lloyd's remains a hub for face-to-face trading. I think the general consensus is that in the absence of face-to-face trading, Lloyd's would effectively lose the essence of what it is, which pleases me greatly. I think there's always a place for that face-to-face trading, and it's what differentiates us from other markets around the world.
And I think outside of that, in terms of the transition coming back into the office, I think some other real positives that we can take from it is, there's that continued focus on well-being of people as well. I think, it's absolutely accelerated that conversation within the market, but also in terms of flexible working, hybrid working, I think we've come on, leaps and bounds in terms of, what we're able to do in that respect. Personally, for me, that means I can drop my kids at school 3 times a week, but I can still be in Lloyd's and, trade face to face. So I think for me, personally, that just opens up a whole different level of, how you can be in this market, but also adapt with recent times and recent, commitments that you have. So I think it's a hugely positive thing that we're in a situation that we're in.
I think there's a big efficiency when you're actually placing risk. If you've already got your terms and conditions, we've sat down together or by Zoom agreed to terms and conditions, and then you just want to get the lines down. That used to be a very tedious process for a broker to run around and wait for every syndicate to do. Now we're using it through, a PPL or a white space. That efficiency has come along, and it started obviously pre-COVID, but it really, I think, the accelerator was pushed heavily in March 2020. So that's the biggest change. So, Phil, you mentioned a minute ago, you were talking about how the market had just started really to change, maybe about 6-8 months pre-COVID. Marine had started to become a harder market, particularly on the excess layers. How do you see that's transition during COVID? I mean, you've talked about some of the challenges of the brokers not being able to get face-to-face with you, but where are we and where do you think we're going with that?
I think the answer depends on which area of the marine market we're looking at. Some of they're at slightly different stages of their cycles. I think if you look at the cargo market in London, I'd say that market is probably flat now. Most of the correction that's taken place over the last couple of years following the Lloyd's Decile 10 process and, a lot of people re-underwriting their portfolios. That's broadly done. We don't write marine hull, so I have less of a sort of oversight on the marine hull space, but I suspect that's sort of flattening off as well. Marine liability, which is my background and Louise's background as well, we're still seeing rate increases in the market for clean business. Undoubtedly, the pace of increase is slowing down. So whereas clean renewals last year were playing to 10 to 15%, now it's kind of 7.5 to 10. The tricky thing with marine liability business, or any liability business for that matter, is that it's difficult to know today whether the rate rise that you've charged is enough, because we don't find out how the policy performed for 4 or 5 years down the line. So what we have seen, and what continues to drive our decision making, is a sharp rise in volatility and volatile claims, especially if people write a book that's exposed to US liability. And our big concern is that any ruling now that comes out of a jury is so difficult to predict, and it's potentially going to add significant volatility in. So what we're trying to do is price for that and build in the correct assumptions around what that inflation looks like, how big is it on an annual basis, and how do we keep up with it from a pricing perspective. But it's not easy, and because there are so many assumptions that go into that, it leads to there being quite a variety of views depending on which underwriter you speak to. So it's a very challenging time, and whilst I sympathise with clients who would say, we've had 3 or 4 years of consecutive rate increase and we've got a great record, the sort of bare facts are that still 3 or 4 years into the sort of hardening market, most London markets are struggling or failing to make money writing marine liability and energy liability business. So it's a tricky situation. I mean, people like us, my syndicate, haven't helped matters because I left my company during lockdown and we joined a new startup, and several other new startups joined around the same time. And naturally that has a dampening effect on rate galvanization and provides more optionality to the brokers. So, there are lots of dynamics at play.
I'm glad you said that, Phil, because I was about to say it wasn't helped by some new entrants into the market.
I wouldn't be arrogant enough to not mention it on the way through. But that's kind of where I think the market's at. But interested to hear your view as well, Louise.
Yeah, I mean, I think I agree with you. We're being challenged with the question of inflation all the time internally, and we're talking to our clients about this as we have our client meetings and things, and it's a tricky one. How do you price for it? Like you say, when you don't actually know the outcome, or that even the litigious environment could change again in the next 5 years' time. So yeah, I agree with what Phil's saying, and yeah, I think the new entrants into the Lloyd's market in the last couple of years, there's some strong leadership capabilities in those new markets. So there's discipline there, but again, there are options there as well for our broking community. So yeah, I would agree with what Phil was saying there.
Yeah, the term I've heard used a lot over here is social inflation, and I think that sort of talks more about how the juries are viewing some of these verdicts. And you see the telephone numbers coming out on some of the big verdicts, but I think there's a lot more of them in that $5 million, maybe even up to $10 million range, which have doubled, 50% more, doubled, maybe even 2.5 times more just in the last couple of years. That they're just not as easy to get them settled at $500,000 or $1 million. They're coming out at that next layer, penetrating the layer, so effectively taking the deductible or the lower layers away, and then costing more within the layer as well. So you've got a double hit, particularly on the excess lines.
Yeah, and also I think as well, the delay in some of these coming through the courts as well. So the inflation is enhanced because actually you might have been able to pay them 2 years ago. So yeah, that's an added thing as well.
Things like virtual depositions and all the things that go into making that settlement are not as good as the face-to-face and the things that go there. Hearings, depositions, the whole process there.
And it's difficult to see how it will ever stop, because plaintiffs' attorneys have got momentum now. They've figured out strategies that work. They know how to litigate these claims. They know how to appeal to a jury. They understand, the tripwires and how to sort of game the system almost. And they make a lot of money doing it, right? 30 to 50% of the overall award goes to some of these plaintiffs' attorneys. I think in the US last year, there was $6 billion of third-party litigation finance. So where hedge funds, banks, pensions are investing money in plaintiffs' attorneys and saying, go speculate with our money. And when this sort of thing becomes a legitimate financial instrument with a return baked into it, the train's left the station, right? It's very difficult to see how this sort of activity is going to slow down. So we can't hope against hope that this sort of stuff is just going to stop. We need to figure out how to underwrite around it, and how to insulate our portfolios from that excessive volatility that we're starting to see.
But I do think that's where kind of the long-term sort of approach of, Lloyd's or partnering with your insureds and, having that kind of long-term view on a client is really important, because I guess you kind of travel through that journey together, so to speak. But yeah, I think that's quite important.
Yeah,
I think it's probably the first time where you can actually have that conversation with a client, or first time with most clients, and they actually realize what's going on. I mean, there's so much publicity about it over here. Every TV show you turn on has the plaintiff's attorney advert on there, and they're aware of it. I think 5 years ago, there were a few clients that got that inflation, but didn't really understand it to the degree that you can sit and talk to them today. And I think that helps from that, as you say, the long-term relationships, sitting in front of the client, talking to them, maybe by Zoom today. But I really think that makes a big difference to have those conversations, not just throw a number out there, but to explain why that number is a reasonable number. Let's do it. So where do you see, I mean, we have a number of agents and brokers on the call today. Where do you see the Lloyd's market being, the Lloyd's marine market being relevant and useful to the US agent and broker today? Louise, you want to give your thoughts? And again, I know we're all liability specialists, but you can try and broaden it out a bit. That would be great.
Yeah, I think it's, I guess, something over the last couple of years, Lloyd has proven that it can adapt, whether that's, adapting products or adapting the way that we're operating. And it provides, my light's gone off, provides competitive advantage. Lloyd does have a competitive advantage. I think going back to that point earlier, if a broker wants to get, it's really bright now. Oh, there we go, that's fine. If a broker wants to get a piece of business placed, they can come into Lloyd's and having that service level, I think that's relevant to the US agency market. You know, we've had a lot of clients in the last couple of months coming back over, seeing their underwriters, you know, hearing it firsthand from us. And I think, you know, that's something that we can continue to, you know, use as an advantage. But it's also that, you know, we can try and improve as well in terms of efficiencies and our costs and things like that. I think if COVID's proved anything, it's that, you know, we can try and adapt to the situation.
Phil, your perspective on that?
Yeah, kind of echo what Louise said. And I think one thing that always strikes me, and this is certainly not meant to be a comment that's disparaging about our sort of rival carriers in the US, but I think typically the London market has demonstrated a more consistent appetite for you know, all areas of US business. So often what we see with the domestic carriers is that, you know, they might get burnt a little bit by a primary book. So all of a sudden, some of those carriers are not writing primaries anymore. They're kind of only writing excesses, and the appetite does seem to chop and change. Whereas I think typically the London market's appetite has always been, we can underwrite our way through these sort of difficult periods and form long-term relationships with clients, as Louise alluded to earlier, right? Where we go on a journey and sometimes, you know, we lose a bit and sometimes we win a bit, but hopefully it's a mutually beneficial relationship in the long term. And I think where we've not lost our way, that would be a strong way of putting it, but where we have, so Lloyd's has always historically been the global center for large complex risks. And I think what we've done in recent years is often try and compete with the domestic markets on business which shouldn't really come to London anyway, because it's relatively straightforward and can be retained domestically. And I think we've certainly in recent years refocused our attention on being the sort of central hub for complex risk that you know, falls outside of lots of other carriers' appetites. And I think that's where Lloyd's will always have a place for, you know, not just US business, but from business coming from all over the world.
Yeah, I mean, I think the complex doesn't necessarily have to be large. I mean, in some cases, one immediately springs to my mind, of course, of maritime employers liability. London created the policy for that some 60, 70 years ago now, and still really leads the world in that marketplace. So I think complexity is absolutely on there, but you know, some of those little MEL policies are 3,500, 5,000. Doesn't always have to be large to be complex.
That's a good point.
But I did want to pick up a little more. You were talking a little bit earlier about the ability to syndicate and to spread risk, and I think that helps an enormous amount, because you may not be very happy, Phil, Louise taking a $10 million on this particular account 100%, but the ability to take, you know, the 5s and 10% and spread that around suddenly gives some more spread of risk. So it gives you some more ability to do things that perhaps you wouldn't want to do 100%.
Yeah,
absolutely. Yeah, gives us diversification.
Yeah. Just again, to remind everybody, we've got the Q&A open. I've got a couple of questions popped in here, so we'll throw these to you. What's the anonymous attendee said, what are the effects of the war in Ukraine on marine risks? And obviously that's Russia, Ukraine, Belarus, all sort of clumped together there. Lou, do you want to start on that one?
well, I think it's, you know, it's very early to sort of tell what the impact's going to be. A lot of our reinsurance treaties are purchased, you know, in a composite basis. So there's a wider impact that, you know, could be possible there in terms of cost of reinsurance.
Phil?
Yeah, I mean, that's certainly the case for us. And I think that composite cover probably won't be available going forwards. Certainly not at a low down level. I think from a loss perspective, it's difficult to tell, but there are a handful of vessels that are currently stuck in port in Ukraine. You know, there's potential war losses there, but I don't think, to be honest, from a marine war perspective, we're looking at eye-watering numbers or anything that's really going to send shockwaves through the market. Of course, the coverage that's available has been restricted. So carriers aren't so comfortable now offering coverage, for vessels going to those areas through the Black Sea, etc. But I think to sort of echo Louise's point, the biggest issue is going to be that marine carriers share their reinsurance program with their war teams. And, in the event that some of these claims materialize, particularly the aviation war claims, which are potentially out there, it could drive reinsurance cost up next year, which will invariably have some knock-on effect to the cost that underwriters are charging in the front door.
We're seeing some of the liability underwriters, a couple in particular, are putting in exclusionary language for any product or ownership or relationship to Russia and Belarus in particular. I think one of the difficulties from our perspective is that it doesn't seem to be a common ground on what that exclusionary language is. So, one syndicate offering this wording and another one offering this wording, but they won't take the first one. So that can get a bit confused, but I think that'll settle down at some stage. Hopefully this won't go on forever, so we don't have to worry about it forever. But right now, I see a bit like the beginning of COVID, different exclusions started to come out and different people had different opinions. I think we're in the same sort of game now with that, particularly on the liability side on the transactions there.
The thing is, if you're owned by US capital and if you have US individuals on your board, OFAC sanctions say that those US individuals can be held personally liable in the event of sanctions breaches. And as such, companies like that have that kind of ownership have to take a zero tolerance approach to any sanction business whatsoever. So what is tricky is that the sanctions regime constantly changes. The list of goods that are sanctioned is constantly changing. And as such, you have to be really vigilant in terms of monitoring your potential exposure to breaching those sanctions, which can get quite tricky.
Louise, something you want to add to that?
No, I was just going to say, in terms of, when you were talking about the pandemic exclusions that came out, I guess it's a symptom of syndicated environment, isn't it? That everybody has their separate, underwriting guidelines or business plans and what they are actually happy to accept. Or so it's the same on the compliance side with the situation at the moment.
So next question is coming from a gentleman by the name of Anthony or Tony. I don't know if he goes by that. How is the marine shipping world dealing with fuel prices, slow port operations, etc., and how these issuing affecting the marine insurance market's daily operation? Either of you wanted to start with that, Phil?
Yeah, I don't think, from an insurance perspective, we haven't really seen much of a knock-on effect from those kind of trade disruptions that we've seen. I mean, most of the world has pretty much come back now from the slowdown that was caused by COVID, with the exception of China, and we're seeing still significant delays in port and in transit in China. To be honest, that obviously causes delay, increased cost as well from fuel prices. Sounds like it should be a big issue, but the demand on vessels is up so starkly over the last few years, and freight rates are up so significantly that don't feel too sorry for these ship owners. They are making an absolute fortune. They're making more money than they've made in many, many, many years, regardless of the cost of fuel and their delays in port. So don't feel too sorry for those guys.
Yeah, and I guess supply chain issues could have an impact to our customers. If they are, increased costs and things like that, maybe their insurance budget might be stretched again if they're, these things are much more tangible, aren't they? Costs of goods or things like that. So could have an effect on that side, but we're not really seeing anything on like a claims front or anything in the liability world anyway. It's
amazing the knock-on effect that those things have. So our managing agent also manages a motor insurance syndicate. And the slowdown in China is causing their loss ratio to go up because a part of the cover they give is for hire cars. Right. Because it takes longer for the parts to arrive to fix your broken car, you have to pay for longer for your claimants to have a hire car. And it just fascinates me that you have, the wings of a butterfly on one side of the world cause a hurricane on the other, right?
Yeah. I mean, actually, I think we're putting the last two together a little bit. You've got to look at things like fertilizer shipments. A lot of that was generated out of Ukraine
Yeah.
So as that conflict started, suddenly fertilizer prices went through the roof, doubled, nearly tripled. From a cargo perspective, suddenly you're having to go out and find additional capacity. If you look at the port operations, let's say Long Beach, LA is probably the worst in the US, are being delayed. Now you've got so many more containers in any one terminal. You do have a loss. It's going to be potentially a much bigger loss. You know, they're stacking 5s and 6s high, where they were stacking 3s and 4s before. So there are knock-on effects to us, but I agree with you both. I mean, I think it's fairly, on the liability side, the only one is that care custody control in the ports. That is certainly, any port I've been to in the United States recently has been, you know, full to capacity, more because of the lack of people to either unload or the truckers to take the containers out of the port. That's really been the backlog in many of the ports, is how do we get the containers out? So that's an interesting point from there. So a question here, again from Anonymous. How do you think the younger generation of insurers might be impacted by more people working from home and there'll be less of an opportunity to face-to-face learning?
Yeah, this is a really interesting one, and it's something that I think about quite a lot, having, you know, quite a large team here, and just making sure that people are getting the right exposure, you know, in terms of learning through osmosis, I guess. And I think the hybrid situation does do that. I mean, we're not dictated that we have to be in the office, you know, a certain amount of days, but we do have like an anchor day with our team, so that, you know, on a Thursday we have our weekly meeting, and everybody, you know, is encouraged to come in on that day. But it's interesting actually recruiting people as well, because they're very keen to have this balance, and so they want to learn and they want to excel in their careers, but they also are not afraid now to say, actually, you know, I do want this work-life balance. And I think that that's a really positive thing. I think that we just have to, you know, adapt and think of different ways of learning, and, you know, what's a learning opportunity. Actually, you know, we get submissions in now, and they're very, very detailed submissions. Often I send that over to my assistant and say, right, tell me what you think of this, rather than obviously him being there at the broke. It's more of a, right, you read that and tell me, you know, and so it's involving him, and then we'll have a meeting afterwards, whether that be virtually or, you know, face to face on the day that we're in the office, and making sure then you pull them in with the broker. So it's kind of just thinking of different ways to involve people, but you definitely need to think about it, because otherwise they could just sit at home on their day from home and not be brought into the conversation.
Phil, what about you?
I completely agree. I think it's on everybody's agenda now, right? Is that as we change the way that we work, we've got this 300-year-old means of learning, which is kind of sit there and watch and listen and hopefully eventually get the hang of it. And that's certainly how I learn. And I think it's how Louise learned. It's how most people in London learn. And that model has been put in jeopardy. So as Louise said, we have to be thoughtful around making sure that we're including people, whether it's on Teams calls or whether it's updating them after we've had a call with somebody to let them know what's happened. And because it's easy to just let, you know, your workload and life sort of bog you down, and you don't get around to doing that sort of stuff. And in addition to that, I think if this is the new normal, we need to not just kind of figure out how to replicate it, but we have to figure out how to do learning and development and bringing people along going forward, whether that's more of a structured learning syllabus. And it's certainly something that we're bouncing around at IQUW. We're looking at potentially building in like a graduate syllabus for people over a 2 or 3 year period, whether it means more, you know, secondments with clients or with brokers or whatever else. But we just have to be thoughtful now, I think. And it's something that we're all going to have to wrestle with over the next couple of years to make sure that we are giving the right learning and development opportunities to our young talent, because otherwise, you know, we'll find it difficult to retain them.
And I think as well, you know, focusing on improving the administrative side, you know, being more efficient on that side will actually free, you know, more junior members of the team up. It'll free their time up to actually go off and, you know, read a wording a bit more, or, you know, look at an account or portfolio management, you know, that kind of side of things. And I think the more efficient we become on that side, the more benefits that they will get as well.
I love the way you described it as learning by osmosis. I think that really does summarize it. I mean, particularly when we were all sitting on boxes, you were sitting on boxes, and I was standing next to you. You know, you're constantly training the person next to you because they're listening and trying to understand. Unless they're in every Zoom call and are paying attention, you can't do that anymore. We, as a relatively small company, ended up developing a formal onboarding process, which, you know, as a big company is fairly accepted, but as a small, you're onboarding somebody right now in Oklahoma. You've got to have something for them to do that is standardized. You can't have them sitting next to you quite in the same.
Yeah, I think as well, you don't, like, obviously learning just by learning from one person is hugely positive, and you can, you know, that's the kind of traditional way, but you also need that diversity of thought. So you need independent learning, you need them to kind of pick it up from lots of different places within their workplace. So I think that will develop a lot more kind of independent learning and diversity of, you know, it's not just going to be carbon copies of the underwriter before them type thing, which doesn't really happen, but you know, it's just a different element to it, isn't it?
Question popped up, have there been any significant cargo losses due to the war in Ukraine, and do you think rates will reduce in the cargo market in 2023? I know, Louise, I don't know how much you have to do with a cargo. Phil, you've got a cargo team, I believe, with you.
Yeah, I do. So the cargo all risks market has been broadly unaffected, I think, by the war in Ukraine. Obviously, they're less able to access business emanating from that region, but from a loss perspective, I don't think there's been very much. There might be, and I think it's still too early to tell, some cargo war losses, which in some syndicates will be written into the cargo account, and in some will be written into the war account. The problem is, you know, you can't get people onto the ground to evaluate the condition of goods and so on and so forth. But I think certainly the noises coming out of the cargo market are that we're not looking at significant loss to the market, and we're not looking at eye-watering numbers. So I think, from a cargo perspective, it looks relatively manageable.
I think you said earlier you were looking at cargo rates potentially flattening for the good account, maybe still continuing to go up for challenging accounts, but for the standard one, you think that we're getting to a flat point or thereabouts?
I think this year the market's flat. You know, not for clean, good, well-performing, well-managed business, the market's flat this year. But the market is up, depending on which sort of subclass of the business you're looking at, between 50 and 100% over a 4-year period. So that can't go on forever, especially when you're not so exposed to the social inflation and the sort of, you know, there are fewer moving parts to cargo, right?
Apart from the actual moving parts.
Yeah, that's just thinking the same
point.
Louise, again, I know you're predominantly liability, but do you have a perspective on that as well?
I don't. I'm sorry, I don't really operate in the cargo market at all. I can't really comment on that market.
I think the only real markets that seem to be still moving up are the ones where, you know, the old dirty word in cargo, stock throughput, you know, where there was stock and very little throughput. Most of those have gone away, but it still seems like the stock part of the cargo market is the one, if anything, is still increasing. In
it was probably slowing down at the start of this year, and then you had the Walmart fire, which is, you know, several $100 million to the market, and it just reminds everybody why they were pushing rates up in the first place.
So we've answered all the questions, so we've got a few minutes remaining now. Crystal ball, where do you see 2023, maybe even 2024? Louise, why don't you have a go at that?
I'm glad you asked Louise to answer that one and not me.
You'll get in a minute, Phil.
It'd be so nice to have a crystal ball, wouldn't it? Yeah. That would be that would be a delight. I mean, it's so difficult, isn't it? It's so difficult to tell what's going to happen. You know, if somebody said to you 3 years ago that this is how, you know, work would be going forward, I think you probably would never have believed them. But my hope would be, you know, in terms of actual the way that we're working, that we continue on this hybrid path, get the best of both worlds. But also my hope, and I'm, in Lloyd's as much as I can be, because I think that is so important going forwards as well. And, we want to be in there, we want to be trading face to face. So I think, that's what I would look for in the future, get people back. And, it's also been good to be traveling again. Business travel is opened up again. We've got clients coming into London, and that experience and that exposure for me is one of, my favourite parts of why I am an underwriter and why I enjoy my job. So in terms of kind of the rating environment and things like that, I think in the liability market, we have had several years of rate rises, but I feel like the goalposts are changing all the time in terms of claims experience that we're having. And I think that, there's still going to continue to be a push in rate rises going forward. And I don't really see that changing over the next couple of years, given the comments on inflation and, the increased cost of claims and things like that, especially, if the actual cost of the goods and things, everything's going up. So that's what I would sort of say in summary.
Phil, how would you add to that?
I don't have much to add to that, to be honest. I think, Louise answered it perfectly. That's exactly my view. I don't think we'll see the level of rate rise that we've seen over the, in kind of 2020 and 2021, which might have been slightly more reactionary. But I think, a consistent and more modest level of rise over the next couple of years is probably the order of the day.
We've seen a huge change in personnel, people changing jobs. Phil, as a good example here, in the middle of COVID and since really the market's reopened. Do you think that's going to slow down at all, or are we in that market that we're just going to see continuously? We have to have an eraser with every business card.
I think part of it is, at the bottom of the cycle, when the market starts to turn and starts to get better, capital is attracted by the sort of positive rating environment. We saw that in whenever it was. When did Convex start? 2019, I guess, 2020 maybe. So you had Convex, then a couple, the following year you had us, IQUW, you had Inigo, Navium, various others. I think as rates start to plateau and potentially come off on an overall market basis, it then becomes less attractive and there's less flow of capital into the market and the sort of new startups dry up. So potentially that means, the musical chairs slows down a little bit as well. But it certainly has been busy over the last couple of years, that's for sure.
I think it's quite a limited, group of people that do what we do, I guess. If you think about how many jobs are available in our marketplace, and people have been able to command, higher wages, or if they've moved, it's a good opportunity for people to take that next step up. So, it took us a long time. We were recruiting for a senior underwriter, and it took us a long time to find somebody. And, I think with notice periods and counter offers, it's a very long process, and it can be difficult, and it's a small pool of people. So, I think that probably will continue for a little while.
I don't think
we've done a lot of
reckon.
recruitment since. Sorry, Ian. I was just going to say we've done a lot of recruitment since we started at IQUW, and certainly in terms of the ones that I've been responsible for, I can say that every single one has taken longer and cost more than we budgeted for.
And I don't think people realise how small it is. I mean, people think of Lloyd's being huge, but our liability community is probably 30, 40 people, something like that. I've never counted it, but it's pretty small. Maybe 50 at tops, depending on where you draw the line, but it's not a big community at all, considering the size. I'll hand it back to Pat just in a second, but I do want to offer you my thanks, Louise, Phil. I really appreciate you taking your time out of your late afternoon to attend this and sharing your knowledge. Pat, back to you.
Well, thanks for having us.
Yeah, thanks for the invitation. It's been a pleasure.
Yeah, big thanks to the entire panel. You managed to cover quite a lot of ground today and some excellent information. And certainly we offer you a big thank you for sharing your time with us today. Much appreciated. And so that will do it for us today. Tuesdays with Lloyd's will be on summer hiatus the month of August, but be sure to mark your calendars for our next session on September 20th. You will definitely want to join this one. It's going to be a very special discussion. Our guest will be Raymond Zinkich, who's president of the Chicago-based Lloyd's cover holder Evertas, which is billed as the world's first crypto asset insurance company. With the massive growth of crypto, we hear all the time, be it in currency or NFTs and so on. This has created a massive insurance need that Raymond will address. And as their own website says, approximately $2 trillion has been invested in crypto, but just 1/4% of that is currently insured. So I guess if there was ever an appropriate use of the term mind the gap, that must surely be it. So as we close our session today, please do take a few minutes to complete the feedback questions that will appear in your browser. Your input is the single biggest determiner of our programming. So please be candid in your comments. You can also drop us a note anytime at usevents@lloyds.com. So until September 20th, let's all keep staying connected, and we hope you have a great rest of your week.
Thank you very much.
Thanks.
Thanks very much.